Hey, welcome to Own Your Future podcast with myself, Eric Clay. Today we're going to have on Lallis Higgins from Lallis Higgins Insurance, and we're going to talk about the wonderful world of insurance. Hey, Derek, how are you?
I'm great. How are you?
Doing good. So one of the things I wanted to talk to you about today is you've helped on a few investment properties and a few of my investors, and so I wanted to get a general scope of insurance with you, but I did want to touch base a little bit maybe on the investment side for maybe some of our investment viewers out there. So introduce yourself and tell everybody a little bit about what you do.
So I'm Lallis Higgins. I'm a founding partner here at Lallis Higgins Insurance Agency. We've been in business going on 9 years this year. Both myself and my partner, we started at Liberty Mutual, which is a direct writer, and then just realized that the independent channel, which is what we're in now, is just we're able to provide more options for our clients, whether it be those investment properties, different business insurance, and we represent probably about 20 to 30 different carriers. So we can find a home for people in a bunch of different situations, depending what the needs are.
Yeah, so you're actually learning to be a pilot or getting your pilot's license, and you can now do airplane insurance?
Yep, I have about halfway through my pilot's license. We've had a few connections with aviation insurance. So I have one client that owns a plane on his own. I have another flying club, a couple hangars that we insure. So it's definitely a passion of mine that is developing in this early stages, but we're growing and learning a lot about the aviation insurance, which is a whole different world than the auto, home, and your typical business insurance. But it's fun. It's always great to learn new things and keep things fresh.
Cool. Well, hey, so you heard it there. If you are a fellow airline pilot or you just airline enthusiast, reach out to Derek because he is too. So one of the things I wanted to talk to you about, so I often have people come to me for investment properties, and sometimes doing investment insurance is a little bit different than doing a regular insurance for your home. So I wanted to talk a little bit about that. So can you tell some people a little bit different what the difference is between maybe a primary house and an investment property when it comes to insurance?
Sure. So the biggest difference, I believe, is with a primary property, they can kind of do a little bit of digging and see insurance history for that individual's owner. But when you have an investment property, typically if it's a multifamily, say 3-family, they really have no way to do any kind of insurance score, any kind of rating based on the individuals in the properties themselves. So in general, it's a bigger liability risk, not knowing that kind of stuff. And, so they're rated, based on that liability risk or not knowing the liability risk. So in general, it's a little bit more than a standard single family homeowner. And same thing with the, replacement cost. You have 3 kitchens, at least 3 baths in a 3-family. So the way the policies are covered are a little bit different as well.
Yeah. So one of the things is you having families in there that obviously aren't occupying that the insurance company doesn't know about. Is there any additional insurance or coverage that you need when you're buying these investment properties?
Yeah, so it's a different policy. It's called a dwelling fire policy. And again, it's rated a little bit differently. It also can take away some of the standard personal property coverage that you have on a normal homeowner's policy. And again, it's rated based on not necessarily knowing who's going to be those tenants. And in general, too, as a homeowner, you care about your investment, you care about your property. Tenants don't always necessarily care for the property as well as a homeowner may. So, there's some additional risks there.
What about investment condos? And condos are getting bigger, especially in Massachusetts with the higher density living. Is there any additional, so for example, a lot of times insurance is covered by the master insurance. Is the condo insurance that the owner would get any different than if they were living there as a primary for a condo?
It's pretty similar. A lot of times there's an endorsement called rented to others that gets put on there. And again, it kind of makes up for the lack of underwriting ability for the condo owner. Also, I always recommend for my condo owners to have their tenants, or even any kind of investment property, the tenants to have a renter's insurance policy is a great idea. It's going to limit the liability risk of the owner, of the unit owner, whether it's a condo or a multifamily, or what people don't realize is, as the homeowner, you're subject to lawsuits. So I've seen, probably a half a dozen times where a tenant had a dog that bit somebody. If that tenant doesn't have insurance, they're going to go towards the homeowner because, the homeowner is responsible for the property. So you're leaving yourself open to potential lawsuits like that, or potential coverage on your homeowner's policy.
So would you recommend anybody that's getting into the investment game get maybe like an umbrella liability policy?
Yeah, I mean, it always helps, especially because, on the auto side of things, if you own a few different investment properties and you get into a bad car accident, those investment properties don't have the same homestead protection that you do on a primary home. So, any equity, you can be forced to sell those properties. So just in that case alone. And then also, you don't necessarily, you can do all the vetting you want for your tenants. But, someone has, someone visiting the property or had a house party or whatever may happen where there's a liability issue and they get sued. It's always going to come back on the homeowner in the end. So it's good to have that umbrella protection. Is going to give you at least $1 million up to $5-10 million or more for a bigger investor. Added protection. I would say you want to build it into the numbers when you're running numbers on the investment property, just because it you never know what could happen. And same thing on your auto side. You could be the best driver in the world, and your foot could get caught. We saw a huge case on the South Shore at the Apple store where the guy drove through the front, killing a person and injuring almost a couple dozen others. Umbrella policy is going to step in and protect those investment properties in a case like that, where it sounds like it was just a terrible accident.
Yeah, that's crazy. So other than that, a lot of the insurance for the investment property is similar to just your regular insurance as a primary residence. Is that correct?
Yeah, it's pretty similar. We can take out the personal property coverage in most cases, which is always something we ask about. Are you renting it fully furnished, or is all the tenant bring in their stuff? Because if you are renting it out fully furnished, you're going to want to have coverage that if the place burnt down to the ground, we can buy all that furniture that you had in there. But if the tenant's bringing all their own stuff in there, it's not going to be covered by your investment property policy, or there could be limited coverage. We could put coverage in there for anything that the owner has in the property, whether it's area rugs or appliances, microwaves, things like that. So there's always the opportunity to put some coverage in there. But then, the stuff that the tenant owns themselves, their clothes, their furniture, TVs, isn't going to be covered by the dwelling fire policy in an investment.
Yeah. So you make a good point about the fully furnished, and that kind of leads into one of my next questions. What's getting really popular nowadays is obviously short-term rentals such as Airbnb and VRBO. But if you had a rental property down on the Cape, many times there's always been short-term rentals down there. So how is the insurance different for short-term rentals, or is there a special coverage that they need?
A lot of times it's mainly just an underwriting issue. There's some companies that are totally fine with doing insurance for the VRBOs or the Airbnbs. There's other companies that don't want to touch it. I think we saw the same on the auto side with Lyft and Uber. There's a lot more companies today that even 3 or 4 years ago that are okay with it. We put an endorsement onto the policy, and again, it depends on how often you're doing it. If it's a complete, VRBO and it's going to be rented as much as possible, you'd probably stick with the dwelling fire. We also have clients that, maybe they use it most of the year and they rent it out 3 or 4 weeks a year, just for random times that they might not be using it. So we really got to ask how long or how often is it going to be used as a rental property, and then we can decide on what product or what type of policy to give them from there. But it's a lot of times people used to try to hide it, almost like having a pit bull or a vicious dog that a company wouldn't cover.
Yeah.
But we try to make sure that we let them know there are options for whatever type of policy or, whatever type of use they're going to be using the property for. It's about getting them into the best product for that use, so that there's no surprises where, they didn't tell us, they didn't disclose at all that they were using it for a rental and then have a claim that's denied because they say, my VRBO tenant, burnt the house down, or even if smaller, left the bathroom sink on when they left and it flooded the bathroom or something like that. So it's better to get them into a product that's going to pay out when that claim does happen, even if it's a couple bucks more, or just with a different company or a different style policy. So you always want to fit the policy to the property and then keep it updated as it changes as well. There's a lot of times people will buy, say they buy an investment property and they're living in it for the first year, then they decide to rent the whole thing out. We try to stay on top of that to make sure we switch the policy when the use changes as well, which we see a lot of times. People come over with 2 standard homeowners policies and we ask them, what's the primary, what's, and the other one's an investment, and they just never switched it over because, their agent didn't tell them to, or they didn't remember that they were supposed to. So that's something we always try to do with an annual review, just to make sure they're in the right product.
Great. So what are some coverages that people don't think about that they probably should be looking in and that maybe they don't have on their insurance?
I would say one of the biggest ones we see a lot of nowadays is water backup coverage. It's an endorsement. We try to put it on every quote when we send them out, just because it's probably one of the top 5 issues we see. There's limited coverage on some policies. Other policies limit the coverage on the back end as well. But basically, it's going to cover, a sump pump failure. You lose power and the sump pump in the basement isn't pumping out water. If there's sewage that comes up through a city pipe, a lot of people don't realize that sometimes the city will cover fixing the pipe, but they're not going to cover the raw sewage that backed up into your basement or things like that. So that's a big one that we always try to add on there, at least to have the conversation. If they say, oh, why am I getting charged $100 for this? It gives us the opportunity to make sure we're talking about it. There's a lot of equipment breakdown coverage is something a lot of companies have nowadays that's very cheap, and can also cover some of the systems of the house. Service line coverage. Basically, there's a gap in your homeowner's insurance policy between where your property starts and the city property ends and the house. So if you have any sewage lines or any underground lines that are damaged and you don't have that endorsement on the policy, you won't have any coverage for, the town or the utility coming in and ripping up the ground to fix a pipe or something like that. So those are, 3 really common endorsements that we like to talk about on every homeowner's policy. Again, it's tough because there's, probably dozens of options and a lot of people are price sensitive with insurance, but we try to find that balance of where you're getting a good policy, the premium is reasonable, and you have good coverage for, we try to get as much coverage in there for all the circumstances that could happen. But you have to balance that with the budget as well. So.
Awesome. So one of the other topics I wanted to touch base with you on is condos as well. So condos are getting more and more popular, especially as price values go up. And sometimes in the loan process, additional insurance above the master policy is not required because the master policy has what we call in walls in or studs in, which include betterments and improvements on the policy. And so from a loan perspective, we might not require the condo insurance. And I had a girl who bought a condo, or I should say a woman. I had a woman buy a condo, and I was doing the financing. And I told her, I said, hey, for the loan, the insurance is not required, but you should still get it. And I actually gave out a few names where she could go get the insurance from. And she ended up hiring a plumber. The plumber burned down her unit. and she never got the insurance, and so she was on the hook for the deductible. And I think she just didn't think about it. I don't think it was. She was probably more preoccupied with the loan process. But some people think, oh, well, why do I need to spend an extra, $300 to $400 a year on this? But a lot of times, if you bundle that in, you get a reduction on your car insurance. So it's like almost like the condo, that extra condo insurance is free. Is that correct, or is pretty close to it?
Yeah, I mean, it's a little bit more than a renter's policy, and it really depends on what you're paying on your auto. But I would say in general, you're going to get about $100 or more. If you're paying $1,000 on your auto policy, it's about 10%, give or take. But yeah, sometimes with those larger condo complexes, you could have a $25,000 or $50,000 deductible on the master policy, and for about probably $100 to $200 a year, depending on the property, you can reduce that, and really your personal condo policy is going to fill the gaps in between the master policy and what you don't have. So in her case, she could have put a $500 deductible on her personal policy, and that's what she would have been out of pocket for. Some of the smaller 4, 5, 6 unit complexes, the deductible may only be $1,000 or $2,500, which is a lot more manageable for people. But as the units get bigger, anytime I see a 50 to 100 unit condo complex or more, typically you'll see deductibles in that $10,000, $25,000, $50,000 range. A lot of times, if they have bad losses in the unit, they use the higher deductibles as a way to save money on the premium. And the bigger ones are really good, usually about sending a letter out to the condo owners and saying, hey, this is what we have on the master policy, match up your personal policy with this. Sometimes we see condos in the middle of that, or even the smaller condos, 2 or 3 or 4 condo complexes don't necessarily have the experience. They don't have a team on site that's doing those type of things. So we always ask for the condo docs. We always ask for the master policy to make sure you're filling in those gaps. And again, a good condo policy, could range from $300 to $500 a year, minus the savings on the auto. So it's really $20 or $30 a month in a lot of cases, for what could be, savings of thousands of dollars out of pocket if there is a big claim. So yeah, I recommend them to everyone. They're not required, and again, even so, when you're renting out the condo, then you're not worried about the personal property, which is another huge portion of it. But when you are living there, that's important as well. If your stuff gets burnt in that fire that the plumber caused, you're going to have coverage on the policy, and otherwise you might be waiting months to go through a lawsuit to try to sue the plumber or sue the person that caused the accident. Or if it was something that happened in your unit on your own, you're not going to have anywhere to go, and you're just going to have to pay that money out of pocket. So
yeah. And personal property includes things like the refrigerator, right? Like any appliances or anything like that?
Yeah, usually the appliances, I always explained it as if you flip the house upside down, anything that's going to fall out. So your clothes, furniture, appliances can be hit or miss depending on whether they're attached or not. But mostly the refrigerator, microwaves, toaster oven and stuff like that, we include in there. And again, most policies start at $20,000 to $25,000 in personal property coverage, which I tell people all the time it's an okay amount. But even for a single person, if you start adding up your clothes, furniture, even on a basic budget, you could go over that no problem. And then I've seen clients that have just $25,000 in jewelry or handbags or shoes or whatever else people collect out there. So it can definitely go up from there, but to have at least something basic in there, if disaster strikes, you're going to have, try to make yourself somewhat whole again.
I would hate to lose my $25,000 bag collection. So, so for condos, is there anything additional or different that a condo owner might want to consider when it comes to coverage versus maybe somebody who's buying a single family?
Yeah, I mean, again, it's really, I think, matching up the two policies, make sure they work together. Like there's no reason if you have a $10,000 master policy deductible, the premium for that versus, say a $1,000 master policy deductible, it's only going to be, $10 a month or something like that to make sure it's matched up. So the coverage is pretty affordable, to get your policies to match together. But it would stink to have, no coverage for that master policy deductible. And then, to know that you could have paid $100 a year or so and had the coverage in place versus not having it matched up properly. So it's really you're making the two policies work together, whereas in a single family you have your own policy and it's gonna that's gonna take care of everything for you. But there's a lot of agents that just will want to put something in place really quickly, and I find that if you can have some kind of relationship with the mortgage company or with the realtor, most of the time they're getting the master policy for you, so it's not much legwork on your end, and then you're just making sure that really creating the best value for the policy. Because if you just go in there and assume one thing, the mortgage company said it was an all-in policy and they don't require coverage, that's one thing, but they may not have seen the deductible. So really taking the extra few minutes to get that email sent over to a couple of people, get the documents, we can review them, and we're not lawyers, but we know where to look for the insurance information, and most policies are pretty clear on it. And if not, we can always go back to the condo association and say, hey, can you clarify this? And then really just, set it up right the first time. And it's going to alleviate a lot of the stress that you may have if something does happen down the road.
Cool. So one of the things I also wanted to touch on is some of these commercials that I see on TV that basically say they can save you 10, 15, 20% on your insurance. I find those commercials extremely misleading, but maybe you should tell people why they shouldn't buy into the whole, I can save you 10, 15 or 20% on your insurance.
Yeah. I mean, in general, especially on the auto rates, the state used to have, before 2008, it was a non-competitive market, so all the rates were the same. Now it's totally competitive, so it's really, you got to do a little bit of homework if you're looking for a good rate. There are times where those national companies that pump millions of dollars into advertising are the cheapest policy. There's also times where, they give you not so good coverage, and maybe you could have spent an extra $10 a month and had a really good policy, but you went with a horrible one for a little bit of a cost savings. So as an independent agent, we don't have access to all the markets in the state, but we, most independent agents will have at least a half a dozen to a dozen, and we can do some shopping for you. We know what we're looking at coverage wise, but it's all, they're saving you 10 or 20% off of their base rate. So if their base rate is higher in your circumstance, whatever that might be, you're only getting a 20% savings on their base rate, where the other company that we quote you with might have just lower rates in general. So, you don't need the extra savings. So the discounts really are more of a marketing scheme, in my opinion. It really depends on your situation. A coastal home is going to have tougher rates than a home, 10 or 20 miles from the coast. A really good driver is always going to have better rates than a brand new driver that's always already had an accident or two. So it really, each circumstance is looked at differently with an insurance company until you actually run the numbers through and get, accurate quotes. It really, the discounts themselves are only discounts off of whatever that base rate is. So I think it's a way for people to get in the door. And for me, I look at it as it gets people thinking about insurance, which is where we come in, and, we can provide some value in the way that we can shop for you, and you don't have to really worry about it as much as if you were doing it totally on your own. And there are just some companies that don't really direct to consumer, don't do direct to consumer marketing. So you may not have access to get them unless you went to each individual website and then found individual agents for each company. So definitely more of a one-stop stop.
Yeah, one of the things I find frustrating is that often I find that some of these companies, they, in order to save the customer money, they slash the coverages, and the person's like, "Oh, great, you saved me, $400," but they don't realize that their coverages have been slashed, and people aren't savvy enough, or most of the time they're not savvy enough to compare coverages rather than just comparing price, because comparing price is the easy one. Because everybody knows what a dollar is, but not everybody understands insurance. Do you see that a lot too, where they're slashing coverages?
Yeah, I see a lot. And we get a lot of, we'll ask people what their coverages are if they have their current coverage page, and they'll say, "Oh, I have full coverage." And I'm like, okay, well, on the personal auto policy, there's 12 different coverages. Each of those coverages, for the most part, have 3 to 5 limits, if not more. So it's really full coverage is just a blanket term. I see a lot of, damage to others' property liability on a personal auto policy where they have $10,000 or $20,000 in coverage. With almost every company out there, you can bump that up to $100,000 in coverage. So you're, tripling or quadrupling the coverage, and it's like $1 a month. So is it really worth saving where, I think the average car on the road today is like $30,000 or so. And there's plenty of cars that are over 6 figures, more now than ever. So even the 100,000 in property damage, if you were to total a brand new, high value car, you're going to be on the hook for the rest of that. So we've even talked about with a lot of our clients going up to the next level, which is 250,000 in liability coverage. So there's a lot of stuff that we see on the policies every day that it just doesn't make any sense. And I think, whether they went online and they did a quote themselves and they just lowered the limits because they didn't really know what they were covering, or if it's someone that, they called an 800 number and just wanted to beat a certain rate. They said, "I'm paying $100 a month. Can you get under that?" And they just lower coverages to get under it. Sometimes it's not worth it. It can be worth it. There's times where I explain to clients like, "Hey, we increased this coverage, and that coverage, and you're saving $5 a month, or maybe it's even $5 more expensive a month, but you have proper coverage." I think most people, once you explain it to them, you give them a couple examples, they understand it. And if they're doing it online on their own, or if they're just talking to someone on an 800 number that doesn't explain anything to them, they're just all they can go off of is the price. So, in my opinion, taking the extra 5 or 10 minutes to explain the policy better, at least they're going to understand it for a day, and then, they hope nothing happens. And a year later, they might, give us a call to revisit something. But yeah, it's really not a lot of people understand the policies, and it's a big contract really between them and the insurance company. And unless you're dealing with it on a day-to-day basis, it is really tough to understand.
Yeah. So to get back onto the track of homes, I had one more topic I wanted to ask you about. And it's a little bit of a two-pronged question. It's about home inspections. Mm-hmm. Now, from my understanding, many insurance companies will actually inspect your property after after you get a policy with them, or after you close on your house. And in some cases, you actually recommend, especially houses with deferred maintenance, actually, in some cases, or you'll want to look at the home inspection that the person used for the house, just to see if there's anything that needs to be taken care of. Is that correct? Or maybe you should go into a little bit more detail about that.
Yeah. So basically what the insurance companies are doing, they're trying to mitigate damages. So whether the inspection is for, liability potential issues, if someone were to slip and fall, or there wasn't a handrail on steps that are 4 steps or 5 steps or more, that they're basically looking to protect the client from getting sued and from larger claims happening and being larger than they need to be because there was deferred maintenance. So Yeah, they're really looking to make sure the property, if there's a hole in the roof or if there's shingles missing all over the place, any kind of rainstorm is going to cause more damage than it would if the roof was in really good condition. They look at things like, trees being trimmed back, because if trees are overhanging a house, and there's a windstorm, it's going to cause damage. So they're trying to look to see if there's anything, existing on the house that could cause or has a high risk to cause claims in the future. And then they make recommendations. Sometimes it's like minor things that are just like, okay, can you trim back the tree a little bit, or trim back the bushes? Other times your front steps are crumbling, and if the mailman didn't see that because of a little bit of snow in there and fell down the stairs, or anyone in general, there would be a higher risk of injuries happening. So they are getting, I feel like they're happening more and more. It used to be random with a lot of companies, and they did, inspect 1 out of 5, 1 out of 10 homes. One of the other important things they're looking for too is just to make sure that the replacement cost coverage that was put onto the policy is accurate. There's a lot of people that have been underinsured lately, especially, or maybe, there was an old town assessor's database where it said the house was 1,200 square feet, and no one realized that there was an addition put on 3 years ago that never was updated with the insurance. So the house is, double the value to replace. So part of the inspection, they're looking at the size of the home and making sure that the proper replacement cost was put onto the policy to begin with. So there's a few different things they're looking for. In most cases, if the home's in decent shape, like I said, there could be some basic recommendations. In other cases, there's major recommendations, and they say, okay, we need this stuff fixed within 30 or 60 days, or the policy could cancel. So they're really, it can be a pain in the butt, especially if there are a couple things that need to be repaired, but they're doing it for the betterment of the client, and the insurance company in the long run.
So if somebody's buying a house with that needs a lot of TLC, that has a lot of deferred maintenance, do you recommend them providing you a copy of the home inspection?
Yeah, in some cases that can help us, because it's fresh pictures that were just taken, and a report, that is probably is going to be more accurate than anything that we can find online or through the databases that the insurance companies use. So that can kind of help guide us, and also maybe put them with a company that has less underwriting restrictions, or that may not inspect, or just to help them, prioritize what they may want to fix if they're planning on putting a lot of money into a property. We could say, hey, this is what the insurance company is going to look at, because I think those fixes may not provide value in the market if they were going to, if they were fixing and flipping per se, or, it may, a kitchen remodel might give the property more market value, but, maybe putting a new roof on before you did that would, keep the home safer and limit, water damage of rain seeping into the house or anything like that. So it can help prioritize projects. And like I said, we can kind of work with the companies that we have. Some companies are okay with, projects needing to be done, or just even a different type of a policy, where like a builder's risk policy would be put in place if they were going to do a major renovation. So yeah, all the information we can gather is always going to help us provide the best options for the client.
Have you ever seen an insurance company just outright cancel an insurance policy because of the condition of the house?
Yes, for sure. Like I said, a lot of times it's going to be for multiple things. It's not just, you have, one of the stairs is cracked, but they're looking for different stuff. I just had one that was quoting that was declined before they even went on to quote it, or they accepted the quote, because there was a lot of water damage on ceilings in pictures that they saw online. The front steps were crumbling. There wasn't, on the back porch, there wasn't a handrail. and you could see that, there was rotting on the top of where the roof met the siding. So it was just in general bad condition. So they have the option, if they see those things beforehand, in that case, they decline the quote. We weren't able to move forward with the policy. If they see stuff like that, after the fact, after inspection, the state has a timeline where they're able to cancel the policy prior to, or, if we communicate with them and say, okay, well, the client just bought the house as is, they're doing the repairs. A lot of times we'll submit up pictures and say, okay, the siding was replaced. Here's pictures of that. They fixed the handrail on the back, deck. Here's pictures of that. So it really depends on the condition of the home, and there are options for those homes. Sometimes they're more expensive.
And if your insurance gets canceled because of the condition of the property, in trying to place them with another carrier can be extremely difficult. And if you can, it's typically much more expensive than a typical policy. Is that correct?
Yeah, in general, for sure. Usually there's someone out there that'll do it. But a lot of times the options are more expensive, the more issues you have. It's just a risk tolerance thing. So if the risk is higher because the property is in bad shape, the premiums are going to be higher because it's a more risky. There's a higher probability of something happening. And if something does happen with a home that has issues like that, it's generally, the increases the repair costs of the issue when it does happen. So
you heard that, people. If you're buying a house that needs a little bit of TLC or a lot of TLC, don't hide it from your agent. Help them guide you on what needs to be fixed and how to properly address the insurance company when that happens. Derek, I appreciate you coming on my podcast today and sharing some of your knowledge. I've known you for years now. If somebody wants to get in touch with you because they have questions about insurance, either airplanes or homes, tell them how they get in touch with you.
So you can always give the agency a call. We work as a big team here. Our phone number is 781-277-0673. Or you can email me, Derek at lallisandhiggins.com. And like I said, we're still growing. We're always looking to help people, and willing to take the time to, inform as much as a person wants. There's some people that will go through line by line for every coverage and they want to know what everything is for. And there's other people that just say, Eric recommended you, just give me a policy. I don't want to spend much time on it. And, we try to push them somewhere in the middle, so they understand what they're getting. They make informed choices about the coverages, but yeah, we're always happy to talk to people, even if it's just answering questions.
Awesome. Hey, thank you everybody for watching Own Future Podcast. I'm Eric Clay, your local mortgage guy. Remember to like, share, and subscribe so that people can see my podcast, and we will see you next time.